This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Stock futures pointing to losses as President Trump says he'll decide on a possible Iran strike within 2 weeks. His comments failing to end the uncertainty around whether the US will soon join Israel's attacks. Also ahead, Japan's finance ministry to seek market feedback today on plans to reduce super long bond issuance as it moves to quell market turbulence. Plus, we hear exclusively from the IMAX China CEO, Daniel Manwaring, about their aggressive expansion plans in the world's second biggest movie market.
Take a look at how we're setting up for the major market opens across Asia. We are seeing that geopolitical premium weighing on U.S. futures at the moment, with Nasdaq 100 futures down 0.2%. And you can see oil prices also continuing to gain ground. WTI up 0.2% as we already had Brent crude prices gaining above that $78 a barrel level. In fact, take a listen to what the White House press secretary had to say about President Trump's comments when it comes to U.S. involvement in Iran.
I have a message directly from the president, and I quote, "Based on the fact that there's a substantial chance of negotiations that may or may not take place with Iran in the near future, I will make my decision whether or not to go within the next 2 weeks."
Of course, we're very familiar with that 2-week deadline when it comes to President Trump. Let's bring in senior editor Wendy Benjaminson joining us now from Washington. We actually have a whole story back from 2017 when President Trump would really talk about these 2-week self-imposed deadlines, then miss them. This also sort of feels like a step back from previous rhetoric this time around.
Well, yes, Shery, it is a step back. However, that 2-week thing, just as you said, it's more like a verbal tick that he has, that he always says something will happen in 2 weeks. Time for him seems to equal 2 weeks. So I wouldn't mark your calendar for July 3rd as the day, that the U.S. might get involved in the Israel-Iran war. But yes, in terms of stepping down, you're absolutely right. He rushed home, left early, the Group of 7 Leaders Summit in Canada to come home to deal with Iran. Then he said we might go in, we might not. Then he talked about how Tehran needed to evacuate its people. And comments like that led everyone to believe that maybe even today or this weekend, we were going to hear that the U.S. was going to assist Israel by providing these bunker buster bombs that could take out the nuclear facility that Israel cannot easily.
It's interesting because we've also heard the same sort of rhetoric that he's expressed towards Russia and Ukraine, right, that they kind of need time to fight it out amongst themselves before further U.S. involvement. I do wonder whether strategically this 2-week kind of time frame, is the president hoping that it kind of, reaches a point where it becomes less of a U.S. problem to have to intervene, perhaps?
I definitely think that's part of it. And again, the 2 weeks just seems like words he uses to mean later. But yes, he is backing. He is definitely backing away from the rhetoric. And I think he is hoping that either Iran will capitulate to Israel, which certainly it doesn't sound like now, or they will be so weakened that Israel will be able to finish the bombing campaign and leave them alone. And then he won't have to do anything. Remember that his MAGA base, the people who really voted him into office, believed him when he said, I'm going to focus on America first. And getting into another war in the Middle East would be something that they are objecting to online and on TV and in person. There's a whole faction of his supporters who really don't want this to happen at all.
Bloomberg senior editor Wendy Benjaminson there as we continue to watch the escalation between Israel and Iran and potential U.S. involvement. Let's actually bring in Maria Rost, Rublee, professor of international relations at the University of Melbourne. Great to have you with us. What would U.S. military action mean in this conflict? How much worse could the conflict get from here?
Well, there is a lot of pressure on Trump from Israel to get involved because the only way to take out the uranium enrichment facilities in Fordo is with U.S. bunker busting bombs. And these are 30,000 pounds. Only one can be carried in a B-2 at a time. And so Israel can't finish the campaign against Iran's nuclear program unless the U.S. gets involved. But if the U.S. gets involved, that means that there will be a lot of pressure within the Iranian leadership to attack U.S. facilities. And if that happens, all bets are off. I mean, the U.S. will really, Trump has already threatened that if you touch our people, if you touch our facilities, that's it. And I do think that then, even though, Magda really does not want to see more foreign entanglements, if there's an attack against U.S. facilities or people, then there will be just basically a war cry within the U.S. for a retribution.
We're hearing from experts that Israel can actually hit Iranian nuclear sites even without the help of the United States. How much capacity does Israel have right now to finish this conflict without U.S. involvement? I think you're alluding to the fact that Washington actually needs to be involved, especially if there is a need for regime change.
Yes, look, I mean, Israel has already done a lot of damage to Iranian nuclear facilities. In fact, they just recently bombed, some of the older closed sites. But there's this key site, the Fordow uranium enrichment site. It's buried under a mountain, and the only way to take it out would be bunker buster bombs. In fact, the U.S. would have to drop one, then it would have to drop another on top of it, and possibly another on top of it. Israel does not have that capability. Now, look, Netanyahu has just said recently in the past 24 hours that they don't need U.S. assistance to finish their campaign. So I guess that depends on what do they mean by their campaign. But we can pretty conclusively say that unless Israel is prepared to use nuclear weapons against Iran, which is extremely unlikely, I mean, I think that's pretty much off the table, that Israel cannot get the Fordow uranium enrichment site on its own.
Maria, I think you alluded to this a little bit earlier about, what we're now hearing, the potential for taking down the entire Iranian leadership in this next phase of the conflict. If that happens, what are the ramifications across the region, across the globe, really? What does it mean for the Iranian proxies, and what does it mean for the necessity of US involvement? Because, at this point, where are we going to see that sort of global leadership come from?
Yes, I mean, that's a great question. Netanyahu has said, that regime change could happen, but it is not the intent of his campaign. Of course, that's what he's saying. He may indeed have other plans, that he's not discussing. And Trump has also alluded to the fact that, that assassination of Khamenei is possible. Of course, there are lots of U.S. executive orders against the U.S. assassinating a foreign official. And so, look, if the regime was taken out, then sort of all bets are off. What's going to happen? Some people say that Israel clearly has people in mind, potential, Iranian, domestic groups that could step in that would, while, not friendly to Israel, would be willing to back off the nuclear program. However, other experts are saying that, if something like that happens, Iranian public opinion and the Iranian military, foreign policy elite, it's essentially going to really harden the need for Iran to have its own nuclear weapons to be able to prevent future attacks on Iranian leadership in the future.
I think it's interesting that the assumption and the rhetoric right now is that regime change or the toppling of the leadership is not the main goal here for Israel, for Netanyahu. At the same time, we've of course seen since the October 7 attack a real redirection of what Israel's strategy has been in the region, right? The sort of, deterrence clearly is being seen as not working. They've been a lot more aggressive and when it comes to multiple fronts at this point. Do you think that changes the game when it comes to what we can expect from the Netanyahu government?
Yes, I think so. I think Netanyahu sees that he's been able to carry out things that previously he wouldn't have been able to. I mean, despite all of the protests worldwide against what's happening in Gaza, and even certain Israeli officials being sanctioned by countries such as Australia, essentially Netanyahu sees that he's been able to carry these things out. And now with Trump's implicit approval, or at least not disapproval, being able to carry out these strikes on the Iranian nuclear program. And so, Netanyahu may feel like, now's the time that he's got the freedom to do what he wants. And, the real question is if this is about Iran's nuclear weapons program, which it does seem to be, you can't bomb a country out of its nuclear program. I mean, you can set it back, but unless you're going to sort of erase the universities and industrial capability, countries can always build back, and they'll learn to build back in much more secret ways. Of course, there are ways to detect secret nuclear programs, as we've seen with Iran. That's how we found out about the Fordo site. But really, the question is this effective? And that's why European countries, several European countries are sending diplomats to meet with the Iranian foreign minister today in Geneva to say, how can we fix this before this ends up, we have a conflagration across the entire Middle East, which is going to affect, petrol prices. It's going to essentially affect the cost of everything, even more so than the Ukrainian war.
That sort of goes to the crux of what happens next, right? Not just in the next 2 weeks, depending on what the US does, but kind of in the next, I guess, generational sense. How quickly could Iran potentially recover when it comes to the damage done to the nuclear program? And does this sort of attack potentially strengthen the domestic narrative that it needs to have those capabilities?
Yes, I mean, that's a good question. So essentially what Israel has done, they've only set back the physical infrastructure by maybe 3 or 4 months. I mean, they've taken out the above ground uranium enrichment facility at Natanz, but they haven't taken out the underground facility there. And of course, they haven't taken out Fordo. They have taken out, though, in terms of personnel, a number of key nuclear scientists from the reporting that we've seen. But psychologically, look, the question is, will this harden the Iranian leadership and people? The best way to prevent this type of attack against, from a nuclear weapon state, which Israel is to have your own nuclear weapons. And so Iran is in a bit of a hard spot here. They don't have, so they have they have enriched uranium, but it's not highly enriched. However, they could get there in, some people say, 2 to 3 weeks. But highly enriched uranium by itself does not give you a deliverable nuclear weapon. I mean, you've got to convert it from gas to metal. You've got to then turn it into a bomb. And then you have to be able to deliver it. And the only realistic way for Iran to deliver a nuclear weapon to Israel would be on missiles. And then that means you have to miniaturize nuclear weapons, which is a really hard work. And in fact, it took, for example, North Korea, several nuclear tests to do that. And Iran hasn't done any nuclear testing at all. So for the Iranian position is, do we back off? And essentially this is where diplomacy comes in to say, look, Iran is not likely to give up enriching uranium. But if we can come up with a deal that says you can only enrich to 2 to 3%, which is what you need for civilian nuclear power, and have really strict, inspection arrangements so that we can make sure they're not cheating. And if we can keep that in for a while, that could actually then help the Iranian population to say, okay, well, so sanctions are lessened, things are getting better, and could potentially give time for domestic sentiment to change, to say we actually prefer engaging in the international economy and international society over the, being hell-bent on a nuclear weapons program that's just going to turn us into an ugly rogue state like North Korea. The problem here, though, is, of course, the Iranian leadership has, a rogue state mindset. It's a, horrific human rights violations against their own people. They engage in terrorism and support terrorist activities. And so that's where the question about regime change come in. Some people say we're never going to get Iran to the place where they're willing to back off nuclear weapons unless we get rid of this regime that is hell-bent on seeing Israel's destruction.
Maria, really great to have you with us. Maria Rost, Rublee, who's the Professor of International Relations at the University of Melbourne. There is more when it comes to the growing impact of the Middle East conflict. In just a few minutes' time, we'll be getting a look at the oil markets with Prestige Economics. Later, we'll be joined by the former US Assistant Secretary of State, Barbara Leaf. Much more ahead. This is Bloomberg. We're seeing global stocks marking 3 days of declines, and that's set to continue as we head into the start of trading, about 45 minutes time here in Asia. We're seeing US futures taking a slide there as well, with Japanese stocks looking to extend yesterday's sell-off. Some interesting dynamics when it comes to what we're seeing across FX. We're seeing that dollar weakness against European FX in particular. The yen is sitting at around a 5-week low there. Aussie and Kiwi are both down to kind of see that clear expression of risk aversion there as well. Let's get now with Garth Reynolds, who leads our Markets Live Asia coverage, of course. So, Garth, this 2-week deadline, it certainly doesn't lend a lot of certainty in terms of what we might expect, given how front-loaded the risks are outside of geopolitics for that time period anyway.
Yeah, well, it reinforces the certainty that uncertainty is the world that we're living in. And yeah, I've been amongst the puzzling lack of reactions, so to speak, to what's been going on in the Middle East is the way that not just markets themselves, but volatility gauges for markets outside of crude oil have been relatively restrained. So the expectation, I suppose, under all of that is that President Trump doesn't just delay once. He'll delay and then he'll delay again. So probably there's at least some chance that the 2-week delay on the US joining in an attack on Iran ends up being an interminable delay, and that we get the reciprocal tariffs delayed again because they're supposed to come in July 9. Treasury Secretary Bessent even flagged the potential that they might be delayed again. So that's that one. The bigger concern, I think, when you look at the mix of US political / geopolitical volatility is what goes on with the budget bill and the debt deadline, which is coming up also in early July. That's not something that can necessarily be put back for 2 weeks. So that might be the one that traders need to focus on more and more as we go forward, depending, of course, on how the Middle East situation develops.
That's the thing, though, Garth, right? I mean, it's the uncertainty. Everything gets delayed. There's no certainty on when things will happen, whether it's on geopolitics, whether it's on trade, as you mentioned as well, making things very, very complicated for central banks. The Bank of England held, but even that decision was divided. And we have 3 other countries needing to cut rates because of the economic uncertainty.
Yeah, well, in fact, those rate cuts are a net positive for Europe, I would argue, because they show that European policymakers are still able to act to help their economies. That contrasts with what's going on in the US, where the Fed has been facing some concerns from some quarters that the economy is showing signs of strain, but they are very reluctant to move towards rate cuts at a time when both what's going on in the Middle East and, more importantly, the impact of those tariffs that have been brought in by President Trump and the tariffs that are hanging like a sort of Damocles over us all, that they could yet come in. Those measures are making the Fed reluctant to ease unless it's absolutely sure it has to. So that's a concern for the US. We've also got concerns in Asia where some central banks have held rates recently, even when they might have been thinking that cutting them would have made more sense. Classic illustration, Bank Indonesia yesterday had to actually intervene to stabilize the rupiah. That's after it held rates earlier this week at a time when it might have otherwise considered cutting, but the currency outlook made it impossible for it to do so. So that's adding to the sense of fragility, I think, across Asian assets, which are also among those that are more exposed to tariff concerns. We all remember how severe the hit was to Asian assets back in 2017, 2018, when President Trump back then was mostly focused only on China, the region's biggest economy. Now that you've got a broader focus for tariffs, that puts a lot of Asian assets on edge outside of some strong rallies for Taiwan and Korea, who have the AI boom on their side.
There's Garfield Reynolds, who leads our Asia Markets Live coverage here. You can follow more on this story, of course, all the day's trading action on our Markets Live blog. That's on the Bloomberg at MLIV Go. This is Bloomberg.
China has been quick to condemn Israel's attacks on Iran, but President Xi Jinping has shown no sign of rushing to provide weapons and other support that would help Tehran face its most critical military test in decades. Let's bring in our China correspondent Min Min Lo in Hong Kong. Min Min, sort of really prioritizing that policy of non-interference.
Yes, that's been a Chinese principle for a long time, and it's unlikely that China will wade into that conflict because, first of all, China wouldn't want to be entangled in a prolonged conflict far away from home that would stretch its resources. At the same time, it also wouldn't want to, run into the risk of getting caught by sanctions. It's similar to China's response to the Ukraine war, where President Xi and China offered diplomatic support to Putin, but were very careful about not providing weapons. And again, China has repeatedly not just called for the escalation of the conflict, but also called for countries with significant influence over the parties of the conflict to do more. And that's a veiled reference and appeal to the United States to do more to calm the conflict. That has the added benefit of distracting Washington from its strategic competition with China. And of course, China has offered to mediate as well, but it's not seen as having enough sway, especially when it comes to Israel. And with China's response to the Israel-Palestine war, Israel is likely already disappointed with that. It's not likely to want to accept Beijing's role as mediator. So for now, China's priority is likely to be a practical one to ensure that its energy security is stable, given that it imports 45% of its oil imports passes through that Strait of Hormuz. It wants to make sure that Iran's energy infrastructure are not attacked and that Iran doesn't stop the flow of oil through that Strait of Hormuz.
Bloomberg's China correspondent Min Min Lo there. More ahead on the Asia trade. This is Bloomberg.
We have breaking news out of Japan. We are getting the core CPI numbers for the month of May, rising 3.7% year on year, coming in above estimates by economists, also accelerating from the previous month. Remember, already core CPI here in Japan around 2-year highs, and it's been staying above that 2% level for around 3 years. When it comes to the headline inflation number, 3.5% year on year, as expected, but it's really the core CPI number stripping fresh food that we're watching for the Bank of Japan, as of course Prime Minister Shigeru Ishiba is also headed towards a summer upper house election, which centers on the cost of of living. You can see right there that the Japanese yen is strengthening a little bit against the U.S. dollar, but after significant weakness, ascended past that 145 level and to a 5-week low against the greenback. Take a look also at how commodities are trading, because Japan, of course, really vulnerable to commodity prices, especially when it comes to imports of oil. It's a net energy importer, and you can see right there the crude prices continue to gain ground. WTI above that $75 a barrel level. Let's bring in Bloomberg Steven Stupczynski, who leads our Asia energy coverage and joins us again here in Tokyo. Are you here for the week? So this is the last day
today
that we'll have you in person, but what a timing to have you here in Tokyo, because we're seeing, of course, oil prices continuing to gain on that geopolitical risk premium. Where do we go from here?
You know, I think right now the market is focusing precisely on what Trump does next, right? I think the market is worried about what Trump will do in this 2-week window. He said he was considering whether to join Israel's offensive in Iran or not. And if they do that, if the U.S. does get brought into this war, then you're going to see a larger spiraling of this conflict. You could see oil infrastructure hit, and you could see Iran and Tehran in a really vulnerable place. And that's when they might say, hey, what are we going to do to hold the world hostage? We could theoretically shut the Strait of Hormuz. It's the conduit for 20% of LNG, 25% of oil trade. It's a really important waterway for global energy. And the market is just really worried about this spiraling out of control and shutting that area.
In fact, you and I were at the Japan Energy Summit yesterday and talking to the Shell CEO, who mentioned this specific risk. Take a listen.
What is particularly challenging right now is some of the jamming that's happening on GPS devices and the like, which is a concern. The Strait of Hormuz is, at the end of the day, the artery through which the world's energy is flowing.
What's the likelihood of that actually happening, a closure, though?
I think the likelihood is still quite remote. I think what the market is pricing is this risk premium. Now, bankers say that if the Strait of Hormuz were to actually shut, oil would go, we're at the $75 level right now, it would go to $130 or more, right? So clearly the market doesn't expect it to happen, but they are taking a position, just in case. I think the more likelihood is you could see Iran maybe target some ships, hit some ships, cause some concerns with ship owners. That could slow down deliveries. That could force other buyers to maybe avoid the area. So you're not going to see a full shutdown, but you could see delays or some people rerouting their flows, and that would lead to higher prices. Now, this is all theoretical at the moment because the Strait of Hormuz isn't shut and it's still flowing, but it's something that the market is watching very closely.
And it would really sort of prevent the options when it comes to reaction from OPEC Plus, right? What could we see from members if the situation continues to deteriorate?
All right. So I think for OPEC Plus, there are two situations that need to be looked at carefully, right? One, we've been talking a lot about the Strait of Hormuz, but Iran is still a major exporter of oil. And if there is some sort of strike by the United States or more strikes from Israel, then you could see Iranian oil output drop. So that's about 1 million barrels a day or so of exports on the market. It's flood. And if that were to happen, yes, that OPEC Plus could likely pick up their production and help to meet that drop. Now, if the Strait of Hormuz were to shut, it would be more challenging for other OPEC Plus members. For example, Saudi Arabia is the world's largest exporter of crude. They're on the other side of the Strait of Hormuz. It would be challenging for them to increase output, if you know what I mean here. And so it becomes this grand reshuffling. It's very difficult to replace 25% of global seaborne oil. So that's why this risk is so intense. That's why the Shell, one of the world's largest energy traders, is kind of focusing on how that is something that likely keeps them up at night.
Steven Stupczynski, who leads our coverage of Asia energy. Let's get some more analysis when it comes to these energy markets. So to Houston we go, and that is where we'll find Jason Schenker, who's the president and chief economist at Prestige Economics. Jason, great to have you with us. And so we're sort of in this holding pattern, I guess, potentially for the next 2 weeks, if that is the timeline that President Trump sticks to before making a decision on US involvement. Where does the market go from here? Because as Stephen just sort of outlined some of the worst case scenarios, we're not quite there yet. How do you assign that risk at this point?
I appreciate being here today. This is a really hot topic that a lot of companies are grappling with, and it could impact everything from business strategies to Fed policy and other central bank policies, impacting eventually U.S. inflation, and even, as we just heard, that hot Japanese inflation number that we heard come out. There's all kinds of inflationary risks that we see from higher oil prices. Where we are right now in the conflict, obviously, we're likely to see these prices remain elevated from where they were before the conflict started. We're quite a bit higher than where we were at that point. Right now we're kind of in that $75 a barrel range for WTI. If this persists for a few weeks, could go a little bit higher. I don't think we're going to see it go much lower. But the point is, right now, prices would be a lot higher if it weren't for all the trade risks and tariff fears and the recent downgrade to global growth forecasts from the IMF. So one of the key things, really one of the only things that's holding oil prices down right now, is kind of a weaker growth outlook and lots of uncertainty around tariffs and trade. If those things get resolved, prices could go up. If the conflict gets worse, or if the conflict system expands to involve the United States, or if then we see somehow oil infrastructure targets become hit, if we see an expansion in the way Iran is attacking Israel and how Israel responds, all of those things present upside risk. The downside risk to prices at this point is, well, if we would see a swift resolution of the conflict and sort of peace breaks out. And I view this as one of the conflict zones of Cold War II. The main first zone we saw start with Russia's invasion of Ukraine. That's not over yet. This conflict still ongoing, and a series of conflicts escalating after you had Hamas attack Israel on October 7th in 2023. So this is part of that conflict still ongoing in the second front of Cold War II, unlikely to end soon.
In the meantime, what sort of expectation do you have from OPEC Plus? Is there any sort of reaction function that we could see here? Obviously, if we're talking about a partial or a full blockade at some point as a worst case scenario, that also limits their options too.
Yeah, I'm much more skeptical about a closing of the Strait of Hormuz. I think then you could see China potentially get involved, because a lot of Iranian crude oil goes predominantly to China. That's predominantly where Iranian exports go. If something cut that off, then a conflict system expansion might not just involve the United States. You could then see China become more actively involved in the conflict in one way or another. So I think everyone wants to avoid that situation, and you can see it in the way the Israelis are targeting very specific assets and targets in order to eliminate the Iranian capacity for nuclear weapons development. That is the very clear objective target that they're working around as a military objective. As far as other risks go, I mean, I think where we are right now with the price action, we could see more prices go up. This is going to be very responsive to daily news feeds of different things ongoing. I would expect prices to remain elevated here, but if this really only lasts a couple more weeks, we could see prices be significantly lower in the fall, especially if we see U.S. Q3 GDP weaken. U.S. Q1 GDP, as you might recall, was slightly negative, minus 0.3%, because of a surge in imports as U.S. importers were rushing to import things ahead of the Liberation Day tariff announcements on April 2nd. So that really hurt Q1 GDP, because when you increase your imports, that weighs on GDP. But because there was a pull forward effect, Q2 GDP could be really big. And if you look at the Atlanta Fed GDP now, the latest numbers from yesterday, June 18th, showed GDP for Q2 is likely to be, based on currently available data, 3.4%. Very positive number, because with a pull forward of imports in Q1, you're going to see a drop in imports in Q2, could see a big GDP number. But by the time we hit Q3, the question is, do we see the U.S. economy slowing more severely? Do we see the global economy slowing more severely? And if this conflict is even a little bit in the rearview mirror, or at least not directly front and center everything we're thinking about, we could see a downside to oil prices in the fall especially because by then the driving season's over. And the biggest seasonal supporter of oil prices in the world is the U.S. summer driving season. Of course, we're in the middle of that right now. But if we get to the fall, Q3 GDP weakens, economic data weakens, driving season's over, and we begin to see this conflict fade from visibility, there's more downside from oil prices once we get to that period of time.
So much uncertainty, right? Whether it's the geopolitics, whether it's the trade tensions. In this environment, it seems gold continues to hold around record highs. The dollar not necessarily reacting as traditionally we would expect it to. What are the safe havens at this point?
Well, I think gold, folks are looking at that for a number of different reasons. I mean, the geopolitical risk has really pushed folks into that. I think there's currency risks because of all the uncertainty. Econometricians tend to talk about the outlook in terms of a distribution curve. Normally, folks think of, a bell curve as a kind of a distribution. But econometricians talk about kurtosis, and it's one of the things you can see in a distribution. And that's when you get fat tails in your distribution. That means the range of outcomes of rare things isn't small. It's kind of big. And so now you have both upside and downside risks that could be significant in the near term. As I've mentioned, and as we heard from the reporter before me, there's all kinds of risks that could happen in terms of if you saw the closure of the Strait of Hormuz, if we saw different kinds of assets that get hit in this conflict, if there's a conflict system expansion, that's bullish in the near term. But if we look to the fall, there's bearish factors there for price action. If we see further slowing of global growth amidst a high interest rate environment, and of course elevated inflation that could be further impacted by these high oil prices, is going to make it more difficult for central banks to cut rates in the fall, just as growth could be slowing more severely. So you have a lot of risks revolving around all markets at this point. I think gold, that's why gold has been so attractive for investors.
With everything that you've said, what do you expect the Fed to do this year?
Well, I think that we are likely to see the Fed cut. Whether we see one or two cuts will depend on the evolving data. As you might recall at the May Fed decision in the press conference, Fed Chair Powell indicated they were waiting for data, using the word wait 23 times in his remarks in the press conference. And he said the words wait and see 11 times. I'll be curious to see the full transcript from the Q&A from yesterday's Fed decision where Fed Chair Powell indicated there was uncertainty. He used that word a lot. And then when he talked about the projections for Fed members, he said there was no conviction around those forecasts. And he said that multiple times. What did they show? The median projections from the Fed members themselves show there's likely to be 2 rate cuts of 0.25% by the end of the year. But the average actually changed. The average went from showing close to 2 rate cuts to now a lot closer to only 1 rate cut. So whether you're looking at the median of 2 rate cuts or the average of 1, it doesn't look like there's going to be too much action in terms of rate cuts by the end of the year. And of course, the Fed is being data dependent.
Jason, always great to have you with us. Jason Schenker, who's the president and chief economist at Prestige Economics. Still ahead here on the Asia trade, more on the Middle East conflict as Ascalon Capital weighs in on how these markets are reacting to President Trump, considering the strikes on Iran, but over the period of the next 2 weeks. And State Street explaining why they think foreign investors are holding firm when it comes to US Treasuries. This is Bloomberg.
Take a look at how Japanese assets are trading at the moment as we just had Japan's CPI with core inflation rising 3.7% year on year, coming in above economists' expectations, also accelerating from the previous month. The Japanese yen strengthening a little bit, really rebounding from that 5-week low against the US dollar. We had seen some pressure send the yen past that 145 level. We continue to watch the JGB market very closely. Of course, we've had incredible volatility in this space, especially last month. month with the 30 and 40-year bond yields rising to record highs. We have seen, of course, the BOJ continuing to pull back from the JGB markets. In fact, earlier this week, slowing down its pullback from the JGB market, given, of course, this ongoing volatility. And now Japan's finance ministry will seek feedback from market players today on its planned reductions to super long bond issuance as it takes other steps to try to again soothe market turbulence. For more, let's bring in senior stock reporter Hideyuki Sano. Hide, so what are we expecting the finance ministry to do, and could this help?
Good morning. At the moment, media reports suggest that the Minister of Finance is going to cut the issuance of 20, 30 and 40-year bonds by 100 billion yen per auction. And given the market reaction to those reports yesterday, that seems to be, roughly speaking, in line with what markets are expecting. Now, what's missing in these reports are what the MOF is going to do with bond buyback. Yes, the finance ministry. So that's an interesting point to look at. Some investors are expecting the finance ministry to do bond buyback, which will help soothe investors' sentiment, but
I mean, we kept hearing that they weren't going to buy back bonds, at least not in July.
Not in July. So I guess that's something the Minister of Finance is looking to discuss at today's meeting with primary dealers, and also there's another meeting with investors next week, I believe. But I think the real test comes when the MOF, the Ministry of Finance, will hold bond auctions, especially after July, when they are going to cut the issuance. So we got 10-year and 30-year bond auction during the first week of July. So that's going to be a very key event for the market.
How much upside risk remains for yields at this point?
For the moment, the market seems to be stable, but as I said, if upcoming auctions produce poor results, then that could revive worries about further rise in yields. And another thing to watch out for is the upcoming upper house election in July. There was debate about tax cut, perhaps until about a few weeks ago. Now the talk has died down a little bit, but depending on the outcome of the election, politicians may start talking about more payouts to consumers. Now, I mean, some people might think that's doable and even desirable, as long as the bond market can cope it. But the question is, I mean, if the fiscal spending is too large, then that could revive worries about Japan's debt sustainability.
Especially with debt to GDP ratio, past 200% exactly. Already. Bloomberg Hideyuki Sano here with us. We have more ahead on the Asia trade. This is Bloomberg.
The latest from the corporate front, Bloomberg learning that developer New World is close to securing an $11 billion loan refinancing deal. One of Hong Kong's most indebted builders is said to have received preliminary consent from all its lenders for the deal. The agreement's success hinges on securing full consent from over 50 existing banks by the end of the month. New World will also have to put up additional collateral for its almost $3 billion in loans due in 2027 and beyond. We've been told that Chinese heating system supplier Zhejiang Sanhua has raised $1.2 billion after expanding the size of its Hong Kong share sale. The company is said to have priced over 400 million shares at the upper end of the price range. Demand for those shares was said to be strong enough to trigger an option to sell 15% more shares than planned. A SpaceX Starship rocket has exploded on a test stand in Texas, causing a massive blast and plumes of flames and smoke. The rocket appeared to be undergoing a routine ground-based engine test. The company says initial analysis points to the potential failure of a pressurized nitrogen tank in its nose cone. It's the first Starship failure in years during a ground test.
Take a look at how we're setting up for the major market opens across Asia. We are getting Nikkei futures now unchanged as we're getting some of those lines from the minutes of the Bank of Japan's May policy meeting. Some BOJ members saying that the bank's stance for rate hike is appropriate. Remember, they kept the rate steady in May. They also kept the rate steady this week, although they did pull back from their withdrawal from the JGB market. That will start happening next April. We have seen a lot of volatility in the bond space. So we have seen the BOJ also slow down that quantitative tightening. One BOJ member is saying that the price trend is unlikely to turn to a decline. This as we just got core CPI numbers here in Japan coming in at 3.7% year on year, accelerating more than expectations, also accelerating from the previous month. BOJ members saying that it's appropriate to raise the rate if the economic outlook is met. That economic outlook pretty murky, given, of course, that Japan is also a big energy importer. Where are oil prices going is a key question. Take a look at how commodities are trading at the moment. Gold, of course, remains around record highs. Take a look at WTI at the moment, past $75 a barrel and continuing to gain ground about 0.4%. As we have Brent prices also above $78 a barrel. And this, of course, Haidi, as we have just heard from the White House saying that President Trump will decide within 2 weeks whether to strike Iran, whether that deadline will be met, of course, is a key question given President Trump's habit of really talking about 2-week deadlines.
Yeah, is that really 2 weeks? Is it sort of just another way of saying at some point in the near future sort of thing? But at any rate, not a great deal of certainty for these markets, right? Take a look at how we're seeing in FX. A pretty kind of nuanced take when it comes to the weakness that we have in the dollar. It depends on what you're looking at in terms of dollar pairs there. That weakness against European FX was pretty well expressed. We're seeing weakness when it comes to the Aussie as well as the Kiwi. The yen at about that 5-week low there as well. Some limited reaction when it comes to a lot of these other asset classes, including treasuries, given the Juneteenth holiday. Market opens are next. This is Bloomberg.
This is the Asia Trade. We're counting down to Asia's major market opens. We're watching oil and, of course, energy assets. Haidi, as President Trump again calls for another 2-week deadline when it comes to a decision to strike Iran.
That just adding an extra level of uncertainty for these markets, right? And, you know, to be fair, 2 weeks could still mean a decision being made to go this weekend. We don't know that either, but certainly it sets up a very potentially volatile start to July as well, given the deadlines related to trade that are coming around the same time, Shery.
Yeah, that also really dampening the economic outlook as we continue to see more central banks around the world shifting monetary policy to a little bit more of an easy stance. We have seen the Bank of England, though, hold steady, although that decision was also pretty mixed. We continue to watch Japanese assets, especially when it comes to the Japanese yen, because it had really fallen to that 5-week low, although in today's session, we're seeing a little bit of a rebound in that 145 level against the U.S. dollar. We're watching the Nikkei and the topics under a little bit of pressure at the moment. Of course, I mentioned energy assets that we continue to watch for. We just got core CPI numbers out of Japan as well, accelerating 3.7% year on year for the month of May, which was really faster than the previous month and faster than economists had expected. We're watching the volatility in the JGB space as well. We actually got a pretty solid 5-year auction on the Thursday session, so a little bit more stability, as we are also hearing from the finance ministry that they will seek market views when it comes to trimming that long debt issuance. Remember, we have seen a lot of volatility in this space, which is a reason also earlier this week we had the Bank of Japan really slow down this pullback from the JGB market as well. Take a look at how Korea is also coming online, because we had the Korean won also falling to a 5-month low against the 1-month low against the US dollar. We're seeing it at the 1374 level and strengthening against the greenback as we're seeing a little bit more upside on the Kospi. But of course, Haidi, is really that geopolitical risk premium that we continue to watch today.
That's right, and we are seeing sort of that muted reaction when it comes to the ability to see a reaction through treasuries, given that it is a public holiday in the US. Oil prices, we're kind of treading water at the moment as we continue to wait for a little bit more certainty in terms of what militarily the next move is, right? So it's kind of steadying picture when it comes to energy prices, and we are seeing Australia coming online a little bit to the upside there after extending that slump, but global stocks were on 3 days of declines. The Aussie dollar actually seeing a little bit of a clawback after we saw earlier weakness for both the Aussie and the Kiwi. Clearly sort of another sort of way to look at that risk proxy play there. Well, Israeli officials say they can penetrate the uranium enrichment hall at Iran's Fordow nuclear site without US assistance. This comes as President Trump says he'll decide within 2 weeks whether to launch a military strike on the Islamic Republic.
I have a message directly from the president, and I quote, "Based on the fact that there's a substantial chance of negotiations that may or may not take place with Iran in the near future, I will make my decision whether or not to go within the next 2 weeks."
Let's bring our Bloomberg editor, Michael Heath. So we've got this 2 week sort of deadline, whether it is 2 weeks or not. But on that sort of first point, what we're hearing from Israel, is that surprising? Because the understanding seems to be that that's a need for the bunker-busting bomb, potentially multiple ones, to be able to access that site.
Yeah, I mean, look, that's always been the consensus opinion. But Israel has said from the outset, I mean, its Prime Minister said, Netanyahu said very early in this campaign, basically a week ago, that that Israel did have a few things up its sleeve, and there's an interesting story on the Bloomberg that our guys in the Middle East have written, talking to former Israeli officials and some off the record current ones as well, who they referenced a mission conducted by special forces in Syria before former President Assad lost power, where these guys had got into a missile facility in a mountain, 120 special forces, and it was a remarkable success. Obviously, Iran is a lot further away, and the logistics are much more difficult, and Iran's military is much bigger and better organised. So it's not simple, but the argument is that if you can either sort of crush the opening of this facility, whereby officials can't get in there for months, that it probably ends up destroying everything as well. And through some sort of commando raid or whatever, boots on the ground. But it's obviously a lot riskier and in many respects it'd be simpler and probably more straightforward if the US does get involved like that.
The 2 week deadline is an interesting one. Is it sort of a stepping back? Because we've seen kind of a similar, let them fight it out for a bit approach when it comes to Russia and Ukraine. Is it because he's obviously dealing with a lot of domestic pressure to not involve the US from his own base? What's going on?
It's hard to read, Heidi, isn't it? I mean, look, he does say that to allow negotiations to go forth. And you imagine, on the Iranian side, if they do, obviously Israel has attacked, we've taken that step. And the idea that the US, it's imminent, it may well have prodded them to come back to the table. And there's every option that they get out of this and they say, that we will give up any
There's no
enrichment.
good faith there from Israel, though, is there?
No.
And that's going to be taken as
why would there be? Because even Iranian officials are still denying that they're trying to develop a nuclear weapon. Now, impartial observers say that's just not the case. So I think this is a bit different from Iraq with the whole weapons of mass destruction. People are pretty confident about what they're doing, and Israel, you're right. Israel's not going to take that on good faith unless it's all verifiable and very, very open as well. So Iran would have to take a lot of steps. The alternative, as you mentioned, is that perhaps it's a bit of a ruse, like we saw that, with President Trump saying to Israel, don't go in there, and then the next morning, of course, the attack began, and something happens this weekend. We really just don't know. So, again, it just sort of lengthens the period of everyone being on edge and uncertainty and volatility, basically, doesn't it?
Yeah, and in the meantime, you, of course, have those casualties by civilians on both sides as well, not to mention that, of course, disruptions to business. U.S. airlines have had to be halted when it goes to airspace around that whole region. What are we seeing in terms of a real fallout on the ground given this ongoing conflict?
Yeah, Shery. I mean, an Israeli hospital was hit yesterday, and it was quite remarkable. They'd actually evacuated it just, I'm not sure if it was a day or very close to a day before. So They managed, it didn't end up doing too much damage. But what had happened there was that the Iranian missile that came through actually then split into various munitions, so it can sort of bypass the missile defences that Israel has. And obviously Israel in turn is bombing a lot of sites. Often in these situations when countries are trying to keep a nuclear process or something like that hidden, they tend to do it often in built-up areas and that sort of thing. So Israel's obviously targeting areas around Tehran, and the chances of civilians being hit are high. We still only, the latest figures we have are sort of unchanged, that in Iran more than 200 people have been killed. In Iran says they're mainly civilians, and in Israel more than 20. But that may have changed because those numbers have been around for a while. But nonetheless, the longer it goes on, the more civilian casualties we're likely to see, the more destruction. And Prime Minister Netanyahu sort of hinted that they'd really love to see a change of government in Iran. But the more that there's an external influence like that, people do tend to unite, and even if they don't like their government, they tend to back them there. So, again, a lot of speculation, a lot of interesting things going on, and a lot of uncertainty that we'll all be watching very, very closely.
Bloomberg's Michael Heath there. Let's get some more on the market view. Isaac Poole, who's the CEO of Ascalon Capital, joins us. And Isaac, as Mike said, a lot of interesting things going on, a lot of uncertainty. How are you navigating this?
Yeah, uncertainty is the key word here. There really isn't a clear view around this political tension, the conflict, on what that might look like over the next couple of weeks. What we can point to is the oil price, which is pushing higher, and I think markets are trying to price out the tails of this potential conflict, and they're fattening up. There are growing risks that this escalates and widens out. For us in our investment outlook, that just means being cautious, not trying to be a hero and trading through this, but just accepting that over the next 2 weeks at least, we're going to be facing volatility and low conviction markets.
How are you sort of investing around this? Because I think you say it's also sensible to assume that even with myriad trade negotiations and deals being struck and deals being worked on, that some level of tariff threat will still be there potentially after next month. So how does that kind of set up the fundamental view for equities around the region and also for US assets?
The tariffs will remain in place, and of course, Liberation Day 2.0, July 9th, is looming pretty large here. There is a real risk that not only are those larger tariffs re-implemented, but that President Trump doesn't back down, and they're implemented for some time. And I think that is a challenge for investors to price in at the moment, because they're so used to the taco trade and President Trump backing out. What that really means is the tariffs will be higher, growth will be slower, inflation will be stickier. This isn't a great environment for equities, particularly when valuations are so elevated. So we think it's wise to be cautious here, not chase rallies, maybe to be a little bit underweight and focus on diversification outside of that big concentrated risk in mega cap US equities, because that is where the risk is skewed to the downside the most, we think.
We, of course, have seen sovereign debt act as a safe haven traditionally, but with the pressure given, of course, concerns about fiscal spending as well, how much of a feasible allocation can that be?
I think there's sort of a lot of confusion around this in some way, because US Treasuries have, after all this year, moved lower in yield. They've moved up in price. The return of the US Treasury index, if you like, is positive. It's doing its role so far, I think, offering some good downside protection, albeit with more volatility that we're used to. I think when you look at Treasuries around sort of 4.25% to 4.5%, that's not a bad place to be still. I think over the next 5 years, you're still going to get 4.5%, 5% return from this. Yes, there is some risk from fiscal policy. Yes, there is some risk from inflation. But I think what we're going to see over the back end of this year is, as the Fed moves closer to cutting, as growth slows, you're going to see a rush of capital come into Treasuries. And I wouldn't be at all surprised to see that yield move back below 4% by the end of the year, reaffirming its role as a safe haven in this outlook.
Does that mean that we're also seeing the dollar starting to normalize? And what does that mean for the other side of the trade, especially with Asian currencies?
Yeah, the dollar is normalizing. It was historically high over the last couple of years. Moving back to where it is now, I think, is a very normal move. And it may weaken against Asian currencies in the near term. But I would imagine that it will find a level and stabilize, particularly against Western currencies and other developed market currencies. And historically, if growth is slowing, if oil prices are increasing, if US Treasury yields are moving lower, this is not such a great environment for Asian currencies. It's not a great environment for the Aussie dollar. I know that there's a lot of positivity around these currencies in the near term. I think that we will see a reversal over the back end of this year, and there will be some weakness come through as these high beta currencies start to look more like they have historically in slowing growth environments.
Isaac Poole, really good to have you with us, CIO of Ascalon Capital there. We have more ahead. This is Bloomberg.
What is particularly challenging right now is some of the jamming that's happening on GPS devices and the like, which is a concern. The Straits of Hormuz is, at the end of the day, the artery through which the world's energy is flowing.
Shell CEO Al Sawan speaking to me at the Japan Energy Summit here in Tokyo as we continue to watch that waterway for any potential disruptions. Of course, we have heard from President Trump saying that he'll make a decision within 2 weeks whether to strike Iran. In the meantime, we continue to see the upside in WTI prices above $76 a barrel in the Asian session, although a little bit of downside for Brent at the moment after surpassing that $78 a barrel level. We continue to reevaluate the risk premium around the geopolitics of Iran. For more on how oil markets are reacting with, of course, the escalation of the conflict between Israel and Iran. Let's bring in our oil reporter, Nicholas Law, who's joining us now from Singapore. So we are now seeing Iran mobilizing its oil exports as fast as it can.
Right, that's totally right. I think what we're seeing is that if you look at satellite images, which our oil team has been doing, we actually see that Iran's Karg Island, the critical export terminal from which it exports much of its crude, those terminals have actually been full. And they're not full because nothing is moving, but because tankers are coming really quickly to pick up these cargoes. In fact, if you look at data, it shows that Iranian exports of oil have increased 44% compared to before the attacks happened. So what we're seeing is tankers in the Gulf of Oman, they're waiting around away from the straits. They dash into Karg to pick up the cargoes, and then they get out ASAP.
So in the worst case scenario, if we see a blockade of the Straits of Hormuz, what are neighbouring buyers like India going to be able to do?
So yesterday, we actually had the oil minister talk to Bloomberg News, the oil minister of India. And what he said is that India is preparing for a situation where if the straits should be closed or supply from the Persian Gulf should be hampered, that India would get its crude from elsewhere other than the Persian Gulf. And not just that, it's also prepared to reduce its oil product exports to the world. Now, India, according to the minister, takes about more than a quarter of its crude imports from the Persian Gulf, and that would mean they'll have to go elsewhere for alternative supply.
And what's going on with diesel markets also rallying so sharply at this point?
Right, so diesel is the workhorse fuel of the global economy, and even before the conflict, levels of diesel in Europe and Americas were relatively limited. Europe, for instance, has been dealing with a couple of refinery outages, and I think some of that's also happening in the US. And what all this crimped supply means is that I think people are worried about what's going to happen to supply coming out of whether Middle Eastern supply risks being at peril. And if it gets cut off, then diesel markets could tighten even more. Just to give you some context, 850,000 barrels a day of diesel last year came out of the Persian Gulf. And so that's why people are worried.
Bloomberg oil reporter Nicholas Wah there. More to come here on the Asia Trade. This is Bloomberg. The CEO of IMAX China says he expects the company's market share to grow in the double digits as they aggressively add screens across the country. The company is betting on big local and US productions to boost sales. And Daniel Mowaring told us exclusively that the movie industry is yet to feel any impact from the trade war.
Business is really as usual. It's pretty great to see. The process of importation is really been very smooth. These films are getting dated with regularity, and there's really nothing very much changed that we've seen over the past few months, and we expect that to continue. So I hear about this trade war, but we haven't exactly felt it directly hit our business.
Why is that? There was a lot of noise, obviously, with the tariffs and Donald Trump's proclamation about bringing films back to the United States and tariffing foreign films that come into the United States. But is that all a bunch of nothing? I know Richard, your boss, has talked about it's just a bunch of noise, but it hasn't been impacting you?
I got to agree with my boss, right? It started out, with a couple of bloggers that basically started some online rumors, and there was about a week of frenzy around it, and then 7 days later, it was very clear that business was back to usual. So I think there's always been a lot of noise, and there will always continue to be some noise. But for our little sector, we're pretty protected from a lot of the outside noise.
What did Ne Zha 2 basically do to the industry? Because that was really the tentpole for the box office success of late. And there is some concern that after that runs its course, that maybe the demand will taper off.
For me, I think Ne Zha 2 proved one simple thing. The audience is there. If you make a good movie, the audience is there. And they showed up in huge numbers. We, year to date, a lot of help from Ne Zha 2, have seen 22 million in attendance for IMAX. Right. That's a very large number. And so I think, it was
double year over year, wasn't it?
It was double year over year, that's great. You got your numbers there. So I think it proves that the theater-going audience in China is really strong. It's really about the content supply.
But how resilient is it? The economy is not doing as well as authorities would like, no doubt. And people are holding on to their discretionary money, their household savings.
Mm-hmm. Well, I think that going to watch a movie is still a really high ROI for people. You're paying less than $10 to be entertained for 2 to 2.5 hours. In the summertime, it's air conditioned. You've got popcorn, you've got Cokes. In terms of time and money, I think it's still a really high value proposition. So I think that's one of the reasons why we're still seeing a lot of growth in our market share. Again, year to date, we're doing 5% of the total box office in China. That's the highest we've ever done in any year. And I think people, again, it goes back to wanting that premium experience for what is, I believe, a really reasonable cost.
What would be the target then, from 5% to what over the next 5 to 10 years? Of course.
From 5 to 100.
You're taking that to Richard and saying that's our business plan for the next 5 years?
No, we don't give ourselves sort of a target number. Yeah. We have less than 1% of the total screens in China. We've got about 800 screens in China. So, doing 5 times that in box office is something we're really proud of. But always I think there's room to grow. And we're going to be pushing the limits into double digits.
The CEO of IMAX China speaking to Bloomberg's Stephen Engel. And other stories that we're tracking on the corporate front. Hong Kong developer New World is said to be close to securing an $11 billion loan refinancing deal. Sources say it's received preliminary consent from all its lenders for the deal. The agreement's success hinges on securing full consent from over 50 existing banks by the end of June. New World will also have to put up additional collateral for almost $3 billion in loans due in 2027 and beyond. We've been told that Chinese heating system supplier Zhejiang Sanhua has raised $1.2 billion after expanding the size of its Hong Kong share sale. The company is said to have priced over 400 million shares at the upper end of the price range. Demand for the shares was said to be strong enough to trigger an option to sell 15% more shares than planned. A SpaceX Starship rocket has exploded on a test stand in Texas, causing a massive blast and plumes of flames and smoke. The rocket appeared to be undergoing a routine ground-based engine test. The company says initial analysis points to the potential failure of a pressurized nitrogen tank in its nose cone. It's the first Starship failure in years during a ground test.
Shery, take a look at how futures in Europe are opening up after what has been a slide for a third day for European stocks on these ongoing geopolitical worries. We are seeing the potential for a little bit of a rebound there, despite, of course, the uncertainty when it comes to US involvement in the Israel-Iran conflict remains very protracted given this 2-week deadline that's been given by President Trump. We are seeing Euro Stoxx 50 futures up by just about 0.5%, also some upside when it comes to German DAX futures. Watching UK assets as well, the Bank of England holding rates steady, but it was sort of a pretty split vote with the monitoring of these deeply concerning Middle East events, the potential impact on rising oil prices and feeding through to inflation as well. There are further bets on cuts from the BOE with a potential quarter point in August, and the BOE governor saying that rates remain on that gradual downward path. When it comes to FX, we have seen that dollar weakness really being expressed mostly through a lot of these European currencies, and at the moment this is a picture when it comes to dollar yen trading at the moment. Dollar China is looking pretty flat, and the Aussie actually clawing back some of the earlier weakness, trading just shy of 65 US cents. Shery.
Right. Given, of course, the uncertainty that you mentioned, Haidi, no wonder we saw central banks in Switzerland, Sweden, and Norway cutting interest rates as well. This is Bloomberg. Take a look at how Japanese assets are trading at the moment. Of course, we have seen a strong 5-year auction on Thursday for JGBs here in Japan. So that plus the indications that the Ministry of Finance could be trimming its issuance of longer debt have stabilized a little bit the JGB space. And we also had earlier this week the BOJ slowing down its withdrawal from the JGB market starting next April. But the bond market volatility, of course, has been huge. We have seen the 30-year and the 40-year bond yields rising to record highs last month. For more on this space, let's bring in our Japan economy and government editor, Paul Jackson. Also joining us is State Street Global Advisor, Senior Fixed Income Strategist, Masahiko Liu. Great to have both of you here on set. But Paul, let me start with you because, of course, we want to set the scene of what's happening today and why the Finance Ministry is now focusing on the long end.
Well, we've had a lot of change in the dynamics in the bond market in Japan. And the biggest change to flag is the Bank of Japan. I mean, this has been the whale in the market. I mean, they've been buying most of the bonds, and they're wanting to pull out as they normalise policy. And the problem is the pace that you pull out at the market leads to certain differing amounts of volatility. Now, what we saw earlier this week is they decided to kind of just slow down on their pullback from the market because if you've been buying all those bonds to support the economy for so long, and we're talking huge amounts here. I mean, the Bank of Japan owns like half of Japan's outstanding national debt. I mean, these numbers are crazy. So if you pull back from that, who's going to fill the space? And I think that the issue here is that the banks and the life insurers that used to be dependable buyers of this debt, they are reluctant to go back and fill that space. And we have a couple of regulatory issues here that are feeding into this. And these are kind of ripples from the global financial crisis.
And if we actually see an adjustment coming from the finance ministry, Masahiko, because right now we're hearing that they're going to seek some market views on this, whether they could cut the issuance of longer debt. Would that help with the volatility at this point, given that the BOJ, as Paul mentioned, also acted or announced action earlier in the week?
Definitely, right. I mean, this is the supply and demand dynamics imbalance that we have already flagged for a while, right? And we think with the MOF coming in and sort of changing the composition of the issuance is helping a lot. The lifers are not buying because they don't need so much duration. They have been buying and lengthening the duration for the past 5 years. The banks, on the other hand, the bread and butter is in the value zone, 5 year to 10 year part of the zone, right? Which BOJ owns too much of that zone, 80% of that zone, right, in the 10-year bonds. And
so what does that mean when it comes to the auctions that we're expecting also to happen later this month, also early next month? Could we see more volatility? Will this be, again, a test of appetite?
I think we'll see a bit of volatility, but albeit, not going to see what happened back in May and early June, right? Of course, there's 3 more super long end auction coming up, and we'll see how that clear. But the thing is, the MOF, the gesture of them is very important, right? Let's ignore the numbers, whatever. The gesture of BOJ slowing down the QT pace and also MOF trying to, tweak that issuance composition is very, very important.
That is just a draft that Bloomberg has seen, though. We are expecting that to happen. What sort of action could we see from policymakers?
Well, I think the action from policymakers, we have already seen it, as Mas has mentioned here. We've had the slowing of the pullback from the BOJ, so that kind of helps prop up the demand side of it. And the finance ministry is going to be paring back the issuance of the super long bonds. So that's about from the paper that we've seen, it's about a 9.3% reduction in the issuance for this year. So that kind of reduces the supply side. So it just helps to match up the supply and demand, the balance in the market again. So I think that if they've got the numbers right, and I think the numbers that we've seen are in line with what markets are saying is the kind of the cutting back that is needed, I think the volatility should be down if they've got the figures right. So that is the big question.
Right. I mean, if that were sort of to disappoint, we could see more volatility. Masahiko, when it comes to what we can expect from domestic holders, especially to make JGBs more attractive, how important is this for policymakers here in Japan, but also just globally, given how closely, for example, Treasury moves have tracked even Japanese markets at this point?
I think, the fear of Japan losing the control of the super long end or even the yield curve is overstated. Remember, 90% of JGBs are funded domestically, right? And then Japan national or financial assets of the household is double the debt, right? So in essence, Japan can finance itself for a long time, decades, right? And then what we have here is supply and demand imbalances that is addressable, and BOJ, MOF, they are coming in to address that imbalances. So I think the volatility will be a lot calmer going forward, and that will, it wouldn't be a super anchor for global rates, but then again, it wouldn't be like a volatility creator going forward.
Is it making it really tempting for global investors, though? I mean, PIMCO was saying 30-year JGBs look really interesting. Does that mean that, relatively speaking, other sovereign debt markets could just lose out here?
Sure. I mean, at current juncture, right? If you look at the 530s, which is the spreads of the curve of 5-year versus 30-year, differential of rates of yield, Japan is trading around 190, 200 basis points versus other DM Germany, US is trading at 100 basis points, less than 100 basis points. So to me, it's screaming out really cheap here, right? And then when you see the authority coming in and address this supply balance imbalances, this is a very important gesture that investors love.
And Paul, Masahiko just was talking a little bit about the upcoming elections, the fiscal spending side of things. We do have the upper house elections, and of course that could also affect Japan's overall debt picture and just deficit spending at this point.
Well, I think the scariest aspect of this is opposition parties have been calling for a lowering of the consumption tax. Now, that has major implications for Japan's fiscal spending and dynamics going forward. Now, the government has been saying, look, this is just too risky because don't forget, if you lower the consumption tax, that's something you've got to fill a hole with every year going forward. Whereas the government is suggesting handouts, cash handouts. Yes, it does sound like a repetition of the same old ideas of the ruling party. But in fiscal spending terms, it makes more sense because it's a one-year hit. It hits the budget this year and then it's gone. And so in terms of the fiscal dynamics, that is a safer policy to go with.
And Masahiko, of course, there's fiscal concerns very big when it comes to the U.S. as well. Just as I'm speaking, we're getting some lines from the finance minister, Katsunobu Kato, speaking in Tokyo, saying that there's no obstacle now to the stable issuance of government bonds. So, yes, he's been asked repeatedly, including by us, what's happening with the issuance profile here in Japan. But talking about, of course, the sustainability of fiscal spending, it's kind of a similar issue, Masahiko, with what the U.S. is facing, right? The pressure on the dollar, the pressure on treasuries, perhaps some uncertainty going in there, that the U.S. may be spending itself into a crisis. Eventual crisis, let's not overstate that. I mean, eventually there could be some concerns. And
to me, I mean, like the prices are pretty much fairly priced now. You see U.S. treasuries, there's a term premium being priced in. You see steeper yield curve. And then U.S. dollar is, at a mildly declining trend, right? This is basically, in essence, of people fearing that there's more FX volatility from the uncertainty of what President Trump is creating, right? And also the fiscal unsustainability that people are fearing. But then, to me, I think, the fiscal sustainability issue in U.S. is easier solvable versus countries like France, right? Like France. But so I think, in essence, everything is RV, and a lot of it has already been priced in the market. I think, sometimes we have to take a sit back and look at across the different asset classes. I think fixed income wise, is fairly priced, 4.5% in 10-year and 5% in the 30-year for the US. I think, for long-term investors is screaming as a buy. And as the fourth largest, asset manager in the world, we manage $4.7 trillion globally. What we saw was very interesting because we have two books, right? Like ETF business and also institutional business focusing on the largest, institutional clients globally. We have the AUM of both of that. What we saw since April is the ETF book was a bit volatile. Of course, there's tactical players coming in and out. But then for the institutional part of the business, the flow was intact. So that means that, the long-term investors, real money investors, they are not trading this market that frequently. And then this is, the dollarization issue is on their mind, but then, it's going to take a long time to carry out.
Paul, and as we're speaking right now, Katsunobu Kato continues to give us some comments about seeing a sharp rise in super long yields since April, obviously something that we know. Expect the BOJ to manage monetary policy toward its 2% price goal. This is very key, right? Because the BOJ has slowed down the pace of its pullback from JGB markets, or will, from April next year. But when it faces inflation concerns as well, they still have to normalize. They still have to hike rates when even core CPI this morning came above expectations.
That's right. And, there's two aspects to this, kind of double-edged sword. We're in a world of higher interest rates. We're in a world where Japan's government is going to have to pay more and more each year out of its national budget to service the debt. We're seeing perhaps an increase of over 8 billion yen. 8 trillion yen in just debt reservicing costs over the next few years, according to a government panel. But at the same time, we also must remember that the inflation dynamic also, over time, reduces the value of that, the real value of that stock of debt that Japan has. So in terms of the debt to GDP ratio, over time, we're actually going to see that kind of going down and the dynamics starting to look a little bit more favorable for Japan from that perspective.
Paul Jackson here, joining us in this conversation with Masahiko Liu, senior fixed income strategist at State Street Global Advisors. Really great to get your take. As also right now, we continue to get those headlines from the finance minister, Katsunobu Kato. He knew that we were talking about JGBs, and he's telling us that the government continues efforts toward a stable sale of JGBs, and they expect the BOJ to manage policy toward that 2% price goal, as we, of course, and we should emphasize that trade package with the United States continues to be negotiated, which really brings more uncertainty for policymakers here in Japan. This is Bloomberg. This is like the perfect timing.
The political fate of Thailand's Prime Minister remains uncertain after opposition calls and street protests demanding her resignation. That's following a leaked phone call where she criticised her army. Let's bring in Bloomberg's Avril Hong for the details. So what is sort of the crux over in terms of this controversy? It's all about this phone call.
Yeah, this phone call involved the Thai Prime Minister Paetongtarn Shinawatra and her Cambodian counterpart Hun Sen. And in this leaked phone recording, she was seen as having criticized, even undermining the Thai military. Now, this was over a border dispute with Cambodia in which gunfire was exchanged. But the problem with that optic is that she is actually the leader of this 10-member coalition in which there are a number of pro-military, pro-royalist establishment parties. And following the phone call, the second largest party in the coalition, the Boom Jai Thai Party, announced it would be exiting. And the issue with that is that this now leaves the current ruling coalition with a very slim majority in parliament. And, you know, it's unclear how this crisis is going to unfold. But we also did hear from the Prime Minister, following on from the leaked phone recording, as well as a lot of criticism over her comments, street protests, calls for her resignation. She said it was part of her negotiation tactic, and she has since also apologized for her comments.
What happens if she loses her job? What's next for politics in Thailand?
Yeah, it's very unclear at this point whether she would actually kind of be removed. But if you think back to how she came to power in the first place, as a 38-year-old, she was appointed after her predecessor, Srettha Thavisin, was removed by the Constitutional Court over an ethics violation for appointing a minister who had a criminal conviction. So this current government has already lost one prime minister, and at the time, if you recall, there were a lot of questions about her political qualifications and how she was still in the shadow of her father, Thaksin Shinawatra, who has, of course, still huge support in the rural areas of Thailand. So this phone call is obviously not a great look for her. And even if she's able to keep the support of her three allies in the coalition, she'll have to quickly prepare a new cabinet lineup. So a lot of uncertainty at this stage.
What are the implications for Thai assets? Are we seeing a reaction at this point?
Yeah, we've seen, I think, in terms of the Thai stock markets, foreign investors had already been pooling out about $2.3 billion worth so far this year, because it's one of the economies seen as the most vulnerable from the external challenges in the Asian region. And it's also faced a very slow recovery because of, you know, the absence of these Chinese tourists. And the current government was supposed to be engaging in these key economic reforms. So obviously, with this current political turmoil, it's seen as a huge distraction. And, you know, I think this just casts further doubt among foreign investors as to whether a lot of these reforms can be implemented. So we are seeing that reaction as well. Yesterday, we saw the Thai stock markets doing really badly, and it's also now the Thai stock exchange, the worst performing market in the world so far this year.
Bloomberg's Avril Hong there as we continue to watch the political ramifications in Thailand. And of course, we're seeing the ramifications in the oil markets as well, given the geopolitical tensions in the Middle East. We have heard from President Trump that he will decide on whether to strike Iran within 2 weeks. Crude prices continue to gain ground, although a little bit of a divergence between WTI continuing to rise above $76 a barrel, while Brent crude has now fallen below that $78 a barrel that it topped in the overnight session. We continue to see iron ore also because we have been watching this market, of course, as the trade uncertainty also continues. Just a lot of variables right now when it comes to global markets that investors need to digest. This is Bloomberg.
As China's young people battle a sluggish job market and falling wages, some are turning to fortune-telling and mysticism. And bars and cafes are seeing this as an opportunity to boost their businesses. But our China correspondent Min Min Lo points out the rise of a superstition economy is also drawing scrutiny from authorities.
I'm drawing a divination stick that's supposed to predict my future. But I'm not at a Chinese temple. I'm at a bar in Beijing. These divination bars are popping up across major Chinese cities, where you can order a splash of cocktail with a side of fortune telling.
The bar business has been declining, but spiritual bars are on the rise.
The so-called metaphysics economy, including tarot card reading, astrology, zodiac prediction, energy healing, is one segment of the Chinese economy that's defied the weak consumption sentiment, seeing a 10% growth per year by some estimates. Consulting firm Daxue says economic pressure and uncertainty are driving the search for Zen as China grapples with elevated youth unemployment rates, slow wage growth, and anxiety over job security.
I started buying crystals because when I just graduated, I was confused. My mental state was not good. I felt helpless. At such a time, sometimes when you know there is no way to seek help from the outside world, you would believe in this kind of thing.
I'm walking along the stretch of a Beijing hutong that I used to frequent, and even within a 10-minute walk alone, I've noticed 6 or 7 of these shops selling crystals and amulets and fortune-telling and tarot card reading services. And these are shops that even just a few years ago weren't as commonplace as they are now.
Thanks to social media, there are more and more influencers posting about tarot cards and horoscopes. It gave everyone a channel for self-exploration that gradually created the market demand.
On social media platform Xiaohongshu, the hashtag spirituality has drawn millions of views. Tencent-backed astrology app Ce recorded nearly 2.6 million monthly active users in May, a 36% growth on year, according to data analytics provider Moonfox Data. Then breakthroughs like DeepSeek turbocharged the sector's prominence.
Many of you have DeepSeek now. You love to use it. In fact, one CEO friend of mine asked his employees, what do you use it for? And good question. And the answer was fortune telling.
After the practice went viral, the censors caught up. The app now sometimes returns similar queries with the answer, I do not provide content related to superstition.
For Chinese government, they are always very cautious about anything that's related to superstition and misleading medical claims. So business, they should be really aware of the advertising restrictions, consumer protection laws, and digital platform regulations.
The Chinese internet watchdog launched a campaign in September 2023 to crack down on the spread of superstitious information online. Offline, though, that hasn't stopped consumer brands from seeking creative crossovers to tap into the spiritual demand.
I have noticed a lot of beauty collaborations. The Chinese leading brand, Proya, has collaborated with the temple in Hangzhou. They even launched a co-branded skincare box.
Like the soft toys and blind boxes that are benefiting from emotional spending, prayer beads and fortune-telling are now moving out of temples into malls and bars, putting the spiritual into sips of spirits. Min Min Lo, Bloomberg News, Beijing.
Take a look at how futures are trading at the moment, because we had seen the offshore yuan pretty steady after losses in the previous session. We've seen the FTSE A50 futures now closing to the downside of 0.2%. In fact, we have seen some underperformance when it comes to Chinese stocks in recent weeks, especially against peers. And we're headed now for the biggest quarterly underperformance against EM markets since 2023. Foreigners shifting capital to rivals like Taiwan and South Korea. So we're seeing TAIEX futures also down 0.2%, Heidi.
Take a look at what we're watching in terms of benchmarks trading just for about an hour or so across the region. We are seeing, after 3 days of declines for global equities, a little bit of upside, or is sort of just room to breathe, right, as we have that 2-week deadline set by Donald Trump in terms of a decision being made on U.S. involvement in the Iran-Israel conflict, whether or not that gives a little bit of breathing space or just further uncertainty for these markets. At the moment, we're seeing Korean and Japanese stocks up by about 0.4% apiece. Bit of downside, though, when it comes to Aussie stocks, off by just about 0.5%. Dollar weakness being expressed there when it comes to dollar yen, as well as strength in European currencies. This is Bloomberg.